In this video, we're going to look at a number of the key big macro and market charts and relationships. First one I want to have a look at is the equity versus bond performance ratio, and we're relating that back to trends in global unemployment. So just to explain on this particular chart, the red line is on the right-hand scale is inverted unemployment rate for the G7. So that's come down to about 4.4, 4.5. And the blue line left-hand scale is just basically the ratio of global equity to global bonds. And what you see here, that's a period obviously of outperforming equities and the more recent underperforming period equities relative to bonds. So what I guess is fairly clear on the chart is that generally the two tend to follow each other by and large, and so that if one was expecting a sustained underperformance of equities versus bonds, typically that would be associated with a rising unemployment rate. There have been periods, of course, where the two have diverged. 2015-16 was a point to note here where equities underperformed bonds for some time despite unemployment continuing to improve. Likewise, back in 1998, you had a brief period of equities uh, underperforming bonds quite sharply, only to be reversed as the unemployment rate continued to decline. And then, of course, in 1987, a sharp underperformance of equities v bonds despite a rising unemployment rate. So it's not a foolproof indicator, but it's certainly one worth keeping an eye on. At this point, it sort of suggests that certainly the market is potentially front-running a decline in unemployment, which has yet to eventuate. The next big picture chart I want to have a look at is CapEx, global CapEx to equity markets. Presumably, both this is business investment and also the equity market, global equity market performance tend to run to the same tune, where improved confidence will lead to increased investment, potentially higher equity prices. So the theory goes. So the blue line here is the global equity market. We're based at the year 2000. As you can see there, the recent decline. The other lines on the chart is the green line here is US non-residential investment. The red line here is Japanese investment and investment within the European area. So all three regions have seen a pickup in investment. It may be too early to see a decline in investment. We saw once again in 2015-16 investment went sideways for a bit, while the equity market also fell away slightly, but as yet there's no sign of investment actually rolling over. Now I want to have a look at the relationship now between the equity market and the US ISM. And what we're looking at here now is the ISM New Orders Index. That's on the right-hand scale. And if I just add some more recent data here, the left-hand scale is real returns from US equities. So in real terms, equities are down about 10% over the year. Now this seems quite an extreme number given the decline that we have seen to date in the ISM. This is the new orders series. Now, it did fall away very sharply in the December data, which was out just late last week. But nevertheless, the decline in equities does seem to be a little bit extreme given the decline that we've seen in the ISM new orders index to date. So let's turn our attention now to the latest developments in global growth momentum. In particular, I'm looking at the big four economies. And all we're doing here is looking at the most recent reading for an ISM or a PMI relative to 12-month moving average. And so that's represented by the red area chart here. So that fell away quite sharply, as I just mentioned earlier on. The new orders index in the US fell very sharply. Chinese PMI was also weak, as was Europe. So that's fallen away to levels really not seen since 2012. And what that means, two things to note here, is that the annual growth rate in industrial production, which has already slowed from 4% as soon as momentum went negative to about 2.7%, shows no signs now of arresting its decline. So this is a problem. And the second point to make is typically declining growth momentum is associated with poor equity market performance. Now, the one of the key areas for the US, of course, is what is happening with wages. We had an update on wages growth just recently. So here I'm going to quickly look at what is happening on wages and relate that back to Fed policy. So there's been a lot of discussion around whether how far away the Fed was from neutral and whether indeed they needed to get to neutral or even beyond neutral. Well, in the past 1, 2, 3 cycles, wages growth has got up to around about 4%. That's a right-hand scale, as you can see there. We've seen quite an acceleration over the past 6 to 9 months, picking up to around about 3.4% in December. So we are getting closer, of course, to this period of 4% wages growth, which in the past has been associated with a Fed policy rate being above neutral. Back here in the late 90s, then somewhat early in 95, 96, but basically remained that way through to about 2000, again in 2006, 2007. So at the moment, the Fed is arguably about 75 basis points, perhaps 50 to 75 basis points below neutral. Wages growth is going to be a key factor for investors to focus on as to whether the Fed is going to have to eventually move above a neutral policy settings. Now, the other big macro chart relating that back to market performance is excess liquidity. And let's just enlarge this again. Excess liquidity is measured as money supply growth relative to nominal GDP growth. So I guess the theory is that excess liquidity doesn't go into funding economic activity. It goes towards financial asset prices or all asset prices. And so that's the red line right-hand scale. That's sunk to a low not really seen since 2007, 2008, around about 1.5%, 2% excess after being a very strong tailwind for financial asset prices of about 6% excess from 2012 to 2017. That was associated with the blue line, which is PE expansion. So now we're seeing PE contraction, perhaps consistent with this diminished liquidity environment. And so that remains a negative for markets at the present time. Now I will finish up with just a comment on high yield. And on this chart here, let's just once again enlarge that. On this particular chart, what we're looking at is a red line, which is the New York Fed probability of recession series. Let's just go out 1 year, 2 years in fact. So it's got a probability of recession by 2020 sitting up around about 15, 17%, and that's been climbing for some time. It's the highest since the previous recessions, as you can see here. The darker blue line on this chart is the spreads for the high yield in the US, and you can see where they got to on previous periods where that probability of recession was very high. So where we sit at the moment is spreads have pushed out from about 320 basis points to 550. At 550 basis points is consistent with a default rate of around about 4.5%. which in turn is consistent with a recession probability of about 30%. That is based on I guess the experience that during recessions, default rates tend to move to around about 10%. There's a default rate there and there. And in non-recessionary periods, default rates tend to hover around about 2%. So it implies a 30% probability of recession over the next 12 to 18 months, which is probably not far from where markets are suggesting. It's probably higher than what the New York Fed model is predicting at the moment. Thank you very much.